So this is section 7.5, monetary policy in Australia. So we've already learned a little bit about monetary policy, and we know if interest rates decrease, the aggregate demand curve will shift to the right. And if we also know if interest rates are increased, the aggregate demand curve will shift to the left. But now it's time to go into a little bit more, well, a lot more detail about how monetary policy actually operates in Australia. So you would have heard about an interest rate called the cash rate. And the cash rate is the interest rate that applies to interbank lending in the overnight money market. So I've got a diagram here indicating the overnight money market. This is the only market that the cash rate is applicable to. So let's just, we've been through this before, but we'll go through it again quickly. So let's just imagine that the ANZ has a balance in its exchange settlement account of $1,000. And let's assume that a particular customer of the ANZ writes a cheque out to a customer of the National Australia Bank. Now, and that cheque's for $2,000. What will happen is the NAB customer's account will be credited with $2,000 and the ANZ's customer's account will be debited by $2,000, or the balance will be reduced by $2,000. But at the end of the day, the money needs to be transferred from one bank to another. So the ANZ will want to transfer $2,000 from its exchange settlement account into the exchange settlement account of the NAB. Now, in reality, you can imagine that on any given day, there's millions of transactions between banks. And so what the system works out at the end of each day is the net flow, the net transfer that is required, or the net transfer payment that is required between each bank. We're just considering one transaction to illustrate. So the problem is the ANZ only has $1,000 in its exchange settlement account, and it needs to make a payment to the NAB of $2,000. So what it will do at the end of the day is announce to the participants in this market that it wants to borrow, let's say, $1,500, so that its overall balance becomes $2,500. It can make the payment of $2,000 and still have a positive balance in its exchange settlement account. Positive balance in ESAs is a requirement of the central bank. So you can't overdraw these accounts. Don't ask me what happens if you do overdraw the account. It just never happens. So the ANZ borrows $1,500 from, say, the Commonwealth, and the cash rate is the interest rate that is paid on that $1,500 loan when the money is transferred from the ESA of the CAB to the ESA of ANZ. So that's what the cash rate is. So it's kind of a little bit strange that you can change such a particular interest rate in a very specialized market and have that flow through and affect mortgage interest rates, personal loan interest rates, car loan interest rates. But that's the way it works in Australia. So how does the cash rate flow through and affect mortgage interest rates? Well, the link is actually quite interesting and quite complex. The first thing we need to appreciate is when the cash rate changes, it changes other short-term interest rates. And I've got that in a diagram here. I've got the cash rate in red, and then I've got the 90-day bank bill yield, or 90-day bank bill interest rate in, it looks like a black color. And you can see the degree of correlation. Now, the correlation is not perfect, but if you actually get the data and calculate the correlation coefficient for the 90-day bill yield, I think it will, from memory, it'll come in at about 0.85, something around there. So the correlation is very, very strong. It's almost 1-for-1. Okay, it's, well, 1-for-1 on average over a period of sort of many months. So the correlation is very strong. Now, the reason that we gave for that previously was that the cash market, this market here, the market for one-day borrowing, and the 90-day bill market are substitutable markets. So if you have $1 billion to lend, you're a big player, you could actually put it into the 90-day market once, 30-day market 3 times, the overnight market 90 times. So that's kind of the logic for the high degree of correlation between this very particular cash rate interest rate and interest rates in the broader economy, in sort of money markets. Now, the next thing to understand is that the 90-day bank bill interest rate is the interest rate banks pay to borrow money from lenders around the world for 90 days. Money that they can then lend on to their customers. So you can hopefully see what's happening here. When the cash rate is reduced, it also reduces the 90-day interest rate. And bank bills, that is just the debt instrument that banks use to borrow for 90 days. It's just called a bill. And so when the cash rate falls, the cost to banks such as the ANZ, Westpac, Commonwealth, the cost of them borrowing money for 90 days, that falls as well. And so then, because the cost of bank borrowing is falling at roughly the same rate as the cash rate, the logic is the banks can then pass those interest rate reductions on to customers in the form of lower mortgage interest rates, lower personal loan interest rates, etc. So in a nutshell, the central bank, when it cuts the cash rate, then cuts the cost to Australian banks of borrowing money. I'm talking about short-term borrowing now, 30-day, 90-day, 180-day, everything up to about a year. It cuts the cost of borrowing for short periods of time, then that is passed on to mortgage rates. But there is one complexity here. This would be a very clean-cut relationship between the cash rate and mortgage interest rates if the banks borrowed all of the money that they use to lend to their customers in short-term money markets. Because we know the cash rate and short-term interest rates, short-term rates illustrated by this 90-day bill rate, we know they are very highly correlated. And so if the bank only borrowed using this short-term debt and paying these short-term interest rates, then they would very easily be able to pass on almost one-for-one cash rate cuts to their customers in the form of a corresponding reduction in mortgage interest rates. So what I'm saying, hopefully everyone's following this, what I'm saying is banks need to borrow money to then lend to customers. If Australian banks borrowed all of the money that they need to lend to customers in short-term debt markets, and all of that money from short-term debt markets was being used to fund mortgage lending, then the transmission of cash rate cuts to mortgage interest rate cuts would be very, very clear-cut and easy. It would be just one-for-one. Why? Because the correlation between the cash rate and the interest rates on this short-term debt that banks are using to fund their mortgage lending, the correlation in these interest rates, it's very, very high. The problem is Australian banks use other sources of borrowing or other sources of money to finance things like mortgage lending, personal loan lending. So where do Australian banks get their money from? Right here. Now, this is a publication from the Reserve Bank Bulletin. The title of the publication is called Developments in Bank Funding Costs, and they release this article about once or twice a year. So it's continually updated. It does go into quite a bit of detail. You don't need to read that article that appears regularly in the RBA Bulletin, but this is where banks get their funding from. So this is the source. This is where banks get their money from to then lend on to their customers. So if you go into a bank and ask for $1 million mortgage, this is where the $1 million will come from, these 5 sources. And what we're going to do is keep it easy. we're going to ignore securitization. Okay. And we certainly want to ignore this funding facility, TFF. Don't even go there. So we're going to ignore securitization. That's reasonably complex. Ignore TFF. And equity is simply issuing shares to raise money to then fund lending. But we're going to ignore that as well. So altogether, these account for what? 15%. So we can safely ignore them. So this, on the vertical axis, this does show you the proportion of overall bank funding that comes from each of these sources. By funding, I mean where banks get their money from to then lend money to their customers for mortgages, car loans, etc. So the main sources are domestic deposits. So you've got a savings account, presumably, and you've got maybe $2,000, $20,000, $100,000 in that account. That is what we call a domestic deposit. And that money, the bank will then use that money as a source of funding. This is your savings, a source of funding to then lend that money on to people to fund a mortgage or a car purchase, etc., etc. So domestic deposits, just money, think of it, money in our savings accounts. You may have a term deposit, same thing. Now we know what short-term debt is and we know what long-term debt is. We did that hard work in topics, what was it, 3 and 4, okay? And each of these three main sources of funding, domestic deposits, long-term debt and short-term debt, have different interest rates associated with them. Now, the interest rates are certainly not on the vertical axis. That's not what it's measuring. The vertical axis is measuring the percentage or the share of total funding from each of these sources. So this is saying in 2022, domestic deposits accounted for about 62% of overall bank funding. So the banks obtained roughly 62% of their money that they use to then lend to other customers from domestic deposits. Short-term debt, about 13%, long-term debt, about 12%. Now, the cash rate is the interest rate, or the cash rate is highly correlated with the interest rate on short-term debt. A 90-day bank bill is short-term debt. So if I asked you to look at this pink line, short-term debt, and I asked you, what do you think the interest rate would be? Or what do you think, I'll rephrase that, what interest rate for short-term debt, what interest rate do you think Australian banks are paying for that, for money, for borrowing money from short-term debt markets? That was very long-winded. So what interest rate do you think Australian banks are paying to borrow money in short-term debt markets? If you switched on, you've already got the answer. It's the 90-day bank bill rate, the 180-day bank bill rate, the 30-day bank bill rate. It would be an average of all of those rates. So what I'm getting at is when the Reserve Bank is cutting interest rates, it'll be cutting the cash rate, but that flows through one for one and affects other short-term interest rates. You can see it in the diagram. And so by doing that, they will be, by reducing the cash rate, they'll be reducing the interest rate that banks pay on all of this short-term debt funding, which is about 13%. Some of you may begin to be seeing the issue here. Okay, continue the story. Historically in Australia, the interest rates paid on domestic deposits have been reasonably highly correlated with the cash rate, historically. So when the cash rate is being cut, we know interest rates on short-term debt, they're going to be falling one for one. When the cash rate is being cut, interest rates on domestic deposits are falling close to 1-for-1. Not exactly 1-for-1, but close, if you look at the data. What about long-term debt, though? What is the correlation like between the cash rate and interest rates on long-term debt? We know it's very weak. We've seen the data. We've seen situations in this course where short-term interest rates have been falling, but long-term interest rates have been rising. So it's entirely possible that the Reserve Bank could be cutting short-term interest rates. No, the Reserve Bank could be cutting the cash rate, which will then lower short-term interest rates. And at the very same time, long-term interest rates, which is the interest rate applicable to this long-term debt, those interest rates could be rising. It's definitely happened in the past. Now, most of the time, what happens is when the cash rate is being cut, long-term interest rates are normally moving in the same direction, normally, but nowhere near 1-for-1. So let's just imagine the Reserve Bank has cut the cash rate by 0.5%. No, sorry, the Reserve Bank has cut the cash rate by a full 1%. Interest rates on this short-term debt will be falling by 1% as well. Interest rates on domestic deposits, hard to tell. They may be falling by more than 1% or less than 1%. It really depends upon the availability of savings in the economy and how keen banks are to attract more domestic deposits. If the banks are very keen to attract more domestic deposits, when the cash rate falls by 1%, the banks may only cut the interest rate on domestic deposits by, say, 0.7 or 0.6. So the reduction in interest rates in domestic deposits may not be as large because the banks are trying to make domestic deposit interest rates as attractive as possible under the scenario I've just described. But what's going to be happening to long-term debt when the cash rate is cut by 1%? Well, sort of historically, it might drop by 0.4, 0.5 of 1%. At other times, the interest rate on long-term debt may actually go up. But let's just assume that the interest rates on long-term debt drop by 0.4. See the problem now? The Reserve Bank, the politicians, and the Australian public expect banks to pass on cash rate cuts 1-for-1 to their customers via 1-for-1 reductions in mortgage interest rates. But how can the Australian banks do that if the interest rates that they pay to borrow money to lend to their customers are not moving 1-for-1 with the cash rate as well? How can they do that? Well, you might look at it and think, well, they could the banks could take one for the team, and their profit could get squeezed as a result of perhaps long-term interest rates getting pushed up at the long-term interest rates rising at the time when the cash rate is falling, and the banks should still pass it on. You could argue that they're making plenty of profit, and they should just pass it on. Even the full rate cut should be passed on, even though the interest rates they pay to borrow their money are not falling 1-for-1 with the cash rate. So it's kind of like the Good Samaritan argument. Now, you'd get a lot of Australians agreeing with you if that was your argument. You walk down the street and you'd probably have a dozen good friends if you were singing that tune in less than 15 minutes. But the reality is, the banks generally don't have that luxury. The banks are ultimately owned by shareholders, and the banks have a responsibility to their shareholders to maximize profits. And by passing on interest rate cuts in full, when the interest rates that the banks pay on the money they borrow are not falling by the same rate as the cash rate, shareholders are going to be up in arms pretty quickly about that. And remember, shareholders do have the ability to vote out members of the board. So if banks were in a situation where they were being overly generous with their interest rate cuts relative to what was happening to their cost of funding, that is, they were passing on interest rate cuts in line with the cash rate, even though their funding costs were not falling at the same rate, the banks were doing that, then the senior management, senior executive would come under scrutiny from the industry, from big investors, and from shareholders, everyday people. So our Australian banks have got big decisions to make when the cash rate is cut. If their funding costs are falling at the same rate as the cash rate at that point in time, they can probably afford to pass on the full rate. But if their funding costs are not falling at the same rate as the cash rate at the time that the cash rate is being cut, then they've got a very difficult decision to make. They'll face political pressure, public pressure to pass on all of the interest rate cut. But then that will conflict with the interests of the owners of the company. So, once you look at it from that perspective, once you understand that, you start to appreciate the difficult position that the executive of these Australian banks are in. Now, of course, when interest rates go up, the banks are generally very willing to pass on the full rate cut. That is true. That's well, it's kind of a related issue, but it's kind of a related issue, but I sort of keep that issue separate in my mind. So that's the way that is the way cash rate changes are transmitted to mortgage interest rates. A reduction in the cash rate will affect interest rates on short-term debt almost 1-for-1. Interest rates on domestic deposits close to 1-to-1, but it does depend upon the demand and supply bias, the demand and supply of domestic deposits within the marketplace at the time. And then reductions in the cash rate are only loosely correlated with interest rates on long-term debt. So the idea is you lower the cash rate, it has an effect on the weighted average of all of these different interest rates payable by Australian banks on the funding that they, or the money that they borrow. And then because their funding costs are being reduced, they pass on those reductions in the form of lower mortgage interest rates, lower rates on personal loans. So really what the only issue here is whether Australian banks can pass on cash rate cuts 1-for-1. And is it justified sometimes for them to hold back some of these rate cuts? So now we know what the cash rate is. We know that when the cash rate changes, it affects other short-term interest rates in wholesale money markets. And when those interest rates fall, we've got this sort of complex issue here of banks having multiple sources of funding, each of those sources of funding having different interest rates, the interest rates on each of those different sources of funding having a different degree of correlation with the cash rate, But ultimately, when the cash rate is cut, the cost of bank funding generally will fall, and they will pass those interest rate cuts or interest rate savings on the borrowing onto customers in the form of lower mortgage interest rates as a typical type of lending. So one more slide in this topic. This is a complex one, so I'll create another video for this diagram. This diagram explains how changes in the cash rate flow through, affect aggregate demand and ultimately inflation. And it's actually a lot more complex than a lot of people think. So we'll leave this video there.